Bismillah Rahman Rahim. Assalamu alaikum everyone. Welcome back once again with my SBR Bootcamp Season 5 Module 4. Students, Module 4, we will cover how to handle Section B type question. How to handle Section B type questions. The name of Module 4, Multi-Complex Issues Part 1. So, Section B type questions. First of all, you must have to aware that what's the scope of Section B type questions. Examiner will examine 25 marks of 2 questions. That means exam weightage 50 marks. For each 25 marks question, examiner will examine multi-accounting issues, multi-accounting standards matter, including group account 7 to 8 marks. Blend with conceptual framework, performance measurement, and current development. With Module 4, we will cover multi-accounting standards blend with conceptual framework. Do remember, with all SBR examiner expect you to demonstrate your knowledge and application as well. So number 1, accounting standards. Whenever you are revising your content of accounting standard, you can use my next 2 slides as a checklist, which means these are the accounting standards that's within SBR. That's the scope of accounting standard with SBR. Number 1, group accounts. These 6 topics, make sure you have covered that. Number 2, extensive accounting standards. 1, 2, 3, 4, 5, 6. I'm not reading it. It's very clear here. Number 3, less extensive accounting standard. Number 4, prior knowledge accounting standards. So make sure you have already covered all the content of the accounting standards. Okay. Furthermore, students, whenever you are practicing your SBR Section B type questions, make sure, or you are attempting your exam as well, make sure you are drafting your answer according to examiner expectations. So what's the examiner expectations here? Number 1, the examiner wordings. Student must have to demonstrate the accounting principles behind their calculations. There are 2 things important here. Number 1, your ability to explain the accounting principles. For example, any of the case, if you are writing something about IFRS 5 non-current asset held for sale and discontinued operation, examiner never expect that you have to write exactly the accounting standard wordings. Not at all. During your preparation phase and the revision phase, what you people have done, you have watched the lectures, number 1. You have read the multiple documents, notes, study up, number 2. Answers as well. Number 3, you have done practice as well. So after that, student now become able to explain the principle with his or her own wordings. So that's important to explain the principle with your own wordings. Number 1. Number 2, is this compulsory to mention the complete name of the accounting standard? Is this compulsory to mention the complete name of the accounting standard? Not at all. For example, if you're writing IFRS 5 principle, you just mention IFRS 5. Don't need to mention IFRS 5 non-current asset held for sale and discontinued operation. Even if you're not able to recall the name of IFRS 5, you just mention quickly according to accounting standard. That's important. Another point is about the calculations. Sometimes examiner asks only the calculations. Calculate. So you just mention the calculation. Sometimes examiner mention that explain your calculations. So whatever the calculation you have done, whatever the accounting principle you have done, you just have to interpret. You just have to interpret that calculation. And sometimes student can also do that, drafting the answer including calculations, means all the calculations with their own wordings, rather than to show the calculation and explain the calculations. So just cover the calculation with the explanation. It's also possible. It depends situation to situation, and you can save the time. It's not always compulsory that you have to show the calculation and then explain as well. Sometimes it's very important. For example, calculate and explain goodwill. So it's better to show the working of the goodwill, calculate and explain the goodwill. So first of all, have to mention the calculation of goodwill and then mention the description of the calculation of goodwill. I mean, if examiner asks the principle of goodwill, so you have to mention the principle as well. So a lot of things depends on the situation, depends on the requirement. So we will cover this point with our practice question of the module 4 as well. Furthermore, students, practice. You have to develop an ability without any fear. What's ability? Here the examiner expectation. Candidates have to demonstrate range of skills and abilities, include relating accounting issues and relevant concepts. So how this ability will develop? Practice. आपने घबराना नहीं है और रुकना नहीं है, which means don't be afraid and don't stop. Keep moving. You have to practice the question in a manner that you are developing your ability and you are experiencing something. So during your experience, it may be possible sometimes you write some answer and it's not matched with the model answer. No worries about that. That's a part of your experience. So question number 1 you have done where only 10 or 12% answer it's matched. Move on. Don't demotivate. Move on. Just get rid of this fear. Second question, third question, fourth question, fifth question. Over the period of time, you will become able to develop the ability that yes, for any real accounting issues, I can demonstrate my ability in terms of knowledge and in terms of application. At last, I must say one important thing. Either your social life or either your professional life, what is the right way to communicate? Right way. Number 1, whenever you enter with any communication, either socially or professionally, first of all, you have to mention the principle about that particular issue. And then you will mention that with this scenario, the principle will be applicable in this manner. So this is the thing you have to apply here. If you're really able to explain or communicate your principles, the principles behind the scenario and application of the scenario, automatically your answer having some weightage. Here you will be able to get some marks. That's all. It's very simple. So you need to do practice in this manner. And you need to attempt your SBR exam in this manner. Okay, move on. What you should do for multi-accounting standard issues and conceptual framework. Number 1, 3-step solution. Make sure you have revised all the content of IAS and IFRS with your notes, with the study hub, with the study text, wherever you have covered the syllabus, and conceptual framework content as well. Entire knowledge. First of all, get the knowledge. Number 2, whatever the exam technique I am discussing here with my previous modules and with this module, you have to apply these techniques, including drafting and more. That's time management, planning, all these things. Apply these exam techniques. Practice question from September 18 to December 23 as much as possible. Practice. Section B type question from September 18 to December 23. Practice. First, content, that's knowledge. Number two, techniques. For my bootcamp, apply these things. Number two, conceptual framework. First of all, you must have to aware that Accounting Standard Board has revised the conceptual framework document by 2018, and that's applicable with the SBR exam. First of all, make sure you have a complete knowledge of the content of conceptual framework. That's qualitative characteristics of the financial statement. First thing, you can just make a quick review from the study hub. Knowledge is the core thing. Number two, based on my observation or based on the past exams, examiner examine the conceptual framework with integrated manner. That's A part of the question of the accounting issue. B part, that's something about application of conceptual framework with the accounting issues. That's covered with the part A. It's an example. I will also cover one question, how to handle the conceptual framework with this module. So examiner always examine with the integration here. So make sure that you are not only able to mention the knowledge, but also able to demonstrate the knowledge, also able to apply the knowledge with the case. And this is not very much difficult. So how to develop expertise, review the content, and practice with the application. What's the examiner expectation? To pass this exam, candidates require in-depth knowledge of conceptual framework, knowledge and application as well. So what you should do? Number one, 4-step solution to cover conceptual framework. Mark my word, for conceptual framework, you just invest 4 to 5 hours and you will be able to pass your SBR exam with aspect of the conceptual framework. Once again, what you should do to cover the conceptual framework. Students, if you really want to cover the conceptual framework, including the knowledge and the application aspect, you have to obey these 4 steps. 4-step solution, 4-step simple solution to cover the conceptual framework. Number one, the first thing, revise your conceptual framework content. The easiest way, it's just open the study hub and read the complete content. That's knowledge. Number two, your study notes, study text, study hub, wherever. Number three, exam techniques, how to integrate. Watch this bootcamp. Number 4, practice questions. These 3 practice questions. First of all, what you should do, cover the knowledge from a study hub, study text or study notes from anywhere. Number 2, exam techniques. Watch this bootcamp material, how to integrate the things. Number 4, practice question. DGY, September, December 2019, Phil Company, December 18, and Skyzer, September 18. But what the condition for this practice question to develop the ability? First, you have to attempt, after first 3 steps, you have to self-attempt the question without any fear. Self-attempt the question and then compare your answer with the model answers. Number 1, DGY, number 2, Phil, number 3, Skyzer. You will, after these 4 steps, you will be able to attempt your SBR exam with respect to conceptual framework. So do follow these 4 steps. Your fear, you will be able to get rid this fear. So that's the point. Now, module 4, second phase is about practice question. We will cover 2 practice questions with this module 4. Number 1, question 3, December 23, Jacinta company. Number 2, a practice question of conceptual framework. So let's start Students, let's start practice question. Question number 3, December 23, Jacinta company. But don't forget, whenever you are attempting any question, you have to apply the 2080 rule. 2080 rule. 2080 rule. First, plan your question in terms of allocation of time, in terms of reading very carefully. Reading is an art. Brainstorming, and apply all my drafting techniques. So with this particular practice question, we will cover 2080 rule. I will provide you the guidance about how to plan question, drafting technique, and also we will cover here examiner report diagnosis. Okay, so let's start the question of Jacinta company. Bismillah ar-Rahman ar-Rahim once again. Students, SBR practice question, SBR International, December 23. Question number 3. This is the question number 3. So the question name is Jacinta company. The question number 3. The question name is Jacinta company. So first, always start reading from this main content quickly. Jacinta company is a parent company of a group. Its main business is in the telecom sector. But with the continued expansion of products and services, it has also developed a credit risk management business. Okay, very well diversified. The financial year end, very important, 31st December XX. For any of the question, you must have to identify what's the year end. The functional and presentation currency of Jacinta company and Jacinta group is the dollars. The following exhibits available on the left-hand side of the screen provide information relevant to the question. Number 1, loan portfolio. Describe purchase of credit impaired loan by Jacinta company. Purchased of credit impaired loans by Jacinta company. Credit impaired loans by Jacinta company. Revenues and inventories. Describe a 2-year service agreement with the sale company, a sale of inventory to an overseas subsidiary. Okay, so first the main content, then have to read the requirement. Explain how Jacinta should account for credit impaired loans in the financial statement for the year end 31st December XX. Your answer should include, here examiner mentioned, your answer should include the general entries. 8 marks question. 8 marks question. So first of all, before starting this question, you must ask yourself, do you have the complete knowledge of credit impaired loans in the financial statement? If no, first of all, you have to recall the investment in credit impaired loans. So let's make a quick review. Let's make a quick review of this concept. IFRS 9, purchase credit impaired financial assets. Let's start the discussion about purchase credit impaired financial asset. Students, 2 things. Number 1, first of all, we need to cover what is the meaning of purchase credit impaired financial asset. And number 2, how to account for the purchase credit impaired financial asset. Students, I will call the term PIFA, investment in PIFA, investment in purchase credit impaired financial asset. Okay, so first of all, we need to understand what does that mean. Listen carefully. The meaning about purchase credit impaired financial asset. For example, I'm a company, HQ company, and HQ company need finance, and they have decided to issue bonds. For example, 5% bonds, 1,000, and for the time period of, let's suppose, 6 years. So one of the investor, for example, S company, has decided to invest or to purchase this bond. So that's called investment in bonds. Purchase bonds, that's called investment in bonds. So definitely S company will provide the finance to the H company. And H company has committed that once we will receive the amount, for example, 1,000, we will provide the interest and at the end of the day, the redemption. For example, redemption at par. Okay. So first of all, with HQ company, this is financial liability. This is financial liability. And this investor, S company, invest in the bonds, that's called financial asset. It's very simple. And the total commitment, for example, the redemption time is 6 years. Sir, do let us know where is the concept of credit impaired financial asset. That's called PIFA. Listen carefully. Assume that HQ company very smoothly and as per the commitment has provided the interest for year 1 and interest for year 2. Interest for year 1, for example, 5% multiplied by 1,000 is equal to 50. So year 1, all thing is set. Year 2, all thing is set. But after year 2, the newspaper has mentioned that HQ company now facing some financial difficulties. And HQ company CEO has already admitted that yes, we are facing some financial difficulties and we are not able to provide the 100% of the interest for the remaining 4 years and the principal amount as well. Whatever the commitment we have made 2 years ago, we are not able to fulfill that commitment. So for that particular reason, the bond's market value, it's now become deteriorated. And the market value before this announcement, it's for example 1,000, but after that announcement, the market value of bond is equal to, let's suppose, 765. Here the S company investor is also very much worried. I also wanted to notice one point here. This is the one bond and the HQ company has issued, for example, 5,000 bonds. And there are too many investors like S company. And these bonds are actually floated on the stock market, secondary markets, on the stock market floor. So this market value of bonds now becomes 765 at first after the 2 years, after this announcement. There is an investor, for example, A company. A company already have noticed that the situation has happened and the bond's value has now become deteriorated. Do remember, the market value of bonds now becomes 765, which means all the negative aspects about not that H company not become able to provide the complete interest or the principal and all these things already have affected or incorporated with this market value of bonds. Do remember that. So that is the very important point. Now, A company has invested with this particular bonds. Investment in purchase credit impaired financial asset means the financial asset whose credit impaired means ability to pay interest or redemption has already deteriorated and invested with the amount of 765. I know that there's a question in your mind, sir, if the bonds value or the bonds has become credit impaired, why investor A will invest in this company? Do remember that. With SBR exam, we will not cover this point, why transaction has happened. Instead, we will only cover the point if the A company has invested with that particular financial asset, how to account for. But if you have a question about that, why the investment made with this particular credit impaired financial asset, this will cover with the AFM or FM paper. This is not about a discussion. You can ask me on separately on the WhatsApp. Don't worry. The point is that how to account for the investment of purchase credit impaired financial asset by a company. So first of all, we have covered that. What is the meaning of purchase credit impaired financial asset? And number two, our position is not H company. Our position is not investor as S company. Our position is this A company who purchased this purchase credit financial asset. That's the point. Students, you know very well that if for a moment, if we consider that investor, the S company, that's called investment in bonds. Whenever, for the time being, leave it the impaired financial asset. It's not about the impaired financial asset. Originally, when S company invests in the bonds, whenever the investor purchased the financial asset, IFRS 9 says that you have to record the financial asset, that financial asset debit bank credit, but also open the accounting of expected credit loss. Also open the accounting of expected credit loss. Chances of the company become impaired or make an allowance and whatever the stage 1, 2, 3. I'm not discussing that particular point. And we are not here to discuss the thing about the S company financial asset. But the point is that if A company invests in purchase credit impaired financial asset with this value, so definitely financial asset debit, bank credit, debit, financial asset, credit, bank. Value is definitely 765, the impaired value 765. Here the IFRS, first of all, this is what about the concept of purchase credit impaired financial asset. Here the IFRS 9 says that you don't need to make any allowance. You don't need to make any allowance for this financial asset because it's already credit impaired. Whatever the impairment context has already incorporated with this 765 value. How? I will cover this point, don't worry. So whatever the discussion we have made that purchase credit impaired financial asset, now we need to cover with a basic example. So till now we only covered the concept of purchase credit impaired financial asset. Now with this mindset, let's take an example. 5% bond issued by ZA company. So we are not here to cover the accounting for ZA company. 1st January 21. Originally issued 1000. Originally redemption time 6 years. Redemption at par, commitment at par, effective interest rate 5%. No premium, nothing else. One of the company, assume S company invest in the bonds 1000. So at year 1, everything is perfect. So first 1000 into 0.05. Interest received 0.05 multiplied by 1000. And it's very simple. It's 1000. Everything is going in the same manner. 1000, 1000, all these things. Very simple, very basic, very simple. But afterwards, at the start of year 3, 1st January 2023, newspaper announcement has made, and ZL company has committed that we will only able to provide 50% of interest and 50% of the principal amount. That's all. So the point is that how to determine the value of this bond, because before the year end of year 23, the market value of the bond is 1000. It's 1000 means everything is going on according to the original commitment. Now, how to calculate the market value? The remaining cash flows, future cash flows, is 50% of interest. Do remember, remaining time period is 4 years. So future cash flows, it's only 50%, is equal to 1000 into 5% into 50%. That's 25, 25, 25. And at the end of the day, only the 50% principal amount. So we can say that 500 plus 25, 525. Discounted 5% is equal to 1.05 power minus this. And this is the value. Now calculate the market value. The market value is something about 500. It's about the present value future cash flow. It's about 500. So that means now the market value is become 500. The market value has become 500. Do remember that we are not here to discuss about the accounting of ZA company. We are not here to discuss about original investor. Except the value it's become 5,000. But a third party here, for example, SQ company. SQ company. And with the stock market, we are going to purchase this impaired financial asset whose value is 500. So at very first day, what we will do? Debit financial asset, credit bank. So our role starts from this date. Our role starts with this date. Our role starts as that date. At what date? At 1st January 2023. So we are SQ company, and 1st January 23 we invest this amount. So this is what about credit impaired financial asset. Here no need to make any allowance of expected credit loss. Why, sir? Because whatever the chances of loss has already incorporated with this 500, with this lower value, because original value was 1000. Now the value become 500. So that's why only need to report financial asset and bank credit. No need to make any allowance of ECL. First point. So I hope it's very clear that what is the meaning of purchase credit impaired financial asset. It's very simple. So our role start with this. We are SQ company, or with the original example, the A company. Students, one more thing. How the SQ company will account for this financial asset over the time period? Don't worry about that. Same accounting. Come on. That's the date 23. Year end 23. Balance start with 500. What was the commitment? If the commitment will make as per original, if all the things will settle by original commitment, so effective interest rate is 5%. Interest received 5%. So is equal to 500 into 0.05. 500 into 0.05, but here the minus point. Interest received become same 1000 into 0.5. That's simple, 25, whatever the commitment. But here we will work out with the 25. That's 500. If the things will move on with the same manner, so at the end of the day, 500 will receive whatever the investment made by the SQ company, they will receive the interest and the principal amount as per the commitment. But the last point for this concept, why normally investor like SQ invest with the credit impaired financial assets? Because there may be a chance that credit impair aspects or credit impair losses become reverse. This may also possible. For example, let's suppose total time period 4 years, but after 2 years, it may be possible that there will be another newspaper announcement. Where the CEO of the company mentioned that now our position has become stable. We will make more payments, or we will make not the 50%, but we will make the 70% or 80% or the 100%. So that means the credit impair loss previously impaired now become reverse. So SQ company has invested with the credit impaired financial asset, and after 1 or after 2 years, the impairment become reverse. So what we will do that, so no worries about that. Once the impairment become reverse, we will cover a loss allowance matter in a reverse manner, expected credit loss in a gain manner. But how we will cover this point, how we will cover this particular aspect, we will consider with the Jacinta company. So come on with the Jacinta company. Come on. This is what about the case of the Jacinta company. First, the requirement. First, the requirement. Explain how Jacinta should account for credit impaired loans in the financial statement year end 31st December XX. Your answer should include journal entries. Journal entries. So let's start the reading of the question. Very simple. Jacinta Company purchased credit impaired loans and measures these amortized cost. Jacinta Company, so credit impaired loss, it's credit impaired loans, it's very clear. Jacinta Company correctly calculates the loss allowance at the changes in life expected credit loss since initial recognition of the assets, which effectively change the estimate cash flows. Change. 1st January X6, Jacinta Company bought credit impaired loans with remaining terms of the 4 years and paid 32 million. Very simple, which is equivalent to the fair value. At 1st January X6, remaining contractual cash flows expected to be received 31st December each year. So originally 31st December, at 1st January X6, what are the remaining contractual cash flows? Remaining contractual cash flows, once they were actually purchased, 8.8, 8.8, 8.8 and 8.8. And credit adjusted effective interest rate on the above cash flow is 3.9%. Here we don't need to determine the value of the purchase credit impaired loss. Here already given 32 million. Here we don't need to calculate the effective interest rate. It's already given. And the original expected cash flows, credit impaired cash flows, already mentioned. So when this first part, when we initially recognize the credit impaired loans, it's very simple. Financial asset debit, bank credit, 32 million. That's all. And we will be able to get 1 or 2 marks. Very simple. Number 2, during the year end, 31st December XX, 8.8 million was originally collected. So originally collected, then we will be able to make a amortization schedule. Very simple. So if we start the working of the Jacinta, so initial recognition debit, financial asset debit and credit bank, it's very simple. How much value? $32 million. 32 million, very simple. It's about 1st January XX. Initial recognition, that is about 1st January XX. Now about the reporting date. Here reporting date. Here reporting date. Here reporting date. Here reporting date. With respect to original remaining contractual cash flow. Original here means once Jacinta purchased at 1st January XX. The expected cash flows are these. 8.8 and all these things. And here mentioned during the year end, 31st December XX, 8.8 million was collected. At 31st December XX, the credit worthiness of loans has improved. We will cover this point as well, improvement. Hold on. But first of all, we need to cover the accounting according to the cash flows that actually received. 8.818 million was collected. So now, first of all, year end of X6. Balance start is 32. Interest income with the effective interest rate. 3.9%. 3.9%. So is equal to 3.9%, 1.25. Interest received, it's mentioned, interest received, that's 8.8. So what will be the accounting? 32 plus this minus this, 24.45. 24.45. So what should be the accounting? Simple amortization schedule. Simple. Debit, bank debit. Whatever the interest received. 8.8. Traded. Interest income. What's the interest income? 1.25. And whatever the balance, 7.55. This credit should be financial asset. This credit should be financial. This should be the financial asset. So now you can justify your financial asset. That's here 32, here 32 minus 7.55, that is 24.55. And you know very well, this amortization schedule also reflect the value of financial asset as well. That is 24.45. So this is 24.45. That's equals to this double entry. Sir, why we have made the double entry? Because here the examiner requirement is about to make a double entry. That's why we mentioned the double entry. It's very simple. But students, one more important point here. Before reporting of 31st December X6, another important point. At 31st December X6, the credit worthiness of the loan has improved. And Jacinta now expect the following cash flows to be collected. So, when originally purchased the credit impaired financial asset, we were expecting the 8.8 billion. And in fact, after 1 year, we have received the same amount, 8.8 billion. But by 31st December X6, the newspaper has announced that the credit worthiness has improved and it's something about more to receive. More to receive. So this is what about reversal of impairment. So this is the case of reversal of impairment. Is this possibility that further impairment? It may also possible. But here the case of reversal of impairment. So before reporting of this financial asset at 31st December X6, we need to reconsider the point of the reversal of this impairment. That's an important point. We need to consider the reversal of impairment. What should be the reversal of impairment? First of all, we need to calculate the amount, the value of the reversal of impairment. Value of the reversal of impairment. If we are not considering the impairment, the value is 24.45. But what about the reversal of impairment? We can calculate direct the value of the reversal of impairment. How? Original expected amount, the 8.8 for the remaining 3 years. Do remember, after 31st December X6, remaining time period 3 years. 8.8. But now that's the 10 million. So here the incremental future cash flows, the expected more future cash flows, 1.2, 1.2, 1.2. Discount rate here 3.9%. So is equal to 1.039 power minus 1. And this is the value of, this is the value of reversal of impairment, that is 3.34. Once again, what's about the reversal of impairment? Here 10 million, sorry, here originally expected the remaining time period 8.8, 8.8, 8.8. But after the improvement of credit worthiness, Jacinta now expect to receive 10 million, 10 million, 10 million. So what's the difference? 10 minus 8.8, that is 1.2 million, 1.2 million, 1.2 million. So whatever the present value of these incremental, that is 3.34, 3.34. So this is the value of impairment reversal or impairment gain. 3.34. Sir, how to account for this impairment gain? This is the point. How to account for? Yes, this is one very important thing. If I ask you that, how to make the impairment allowance? So what should be your answer? The impairment allowance should be P&L debit and loss allowance credit. Is this the point? But here the point of impairment gain. Impairment gain. Here the point of impairment gain. How to account for the impairment gain? Debit loss allowance and credit profit and loss account. That's impairment gain. Sir, there are no previous impairment loss here. No worries about that. No worries about that. Normally, if we account for the financial asset, so the parallel accounting of the impairment loss. With case of purchase credit impairment, financial asset, it's possible that at one point the balance sheet reflects 7.55. Sorry, the balance sheet reflect the 24.4 as a financial asset, and on the other side the loss allowance of 3.34. So, sir, with the balance sheet, can we net off? But here the net off, it's not minus. The word net is wrong. It's something about 24.45 plus, because here loss allowance, it's not credit, here loss allowance is debit. Like the allowance for doubtful debts, here the allowance for doubtful debts in a debit point. So like financial asset of 24.45 plus 3.34, that's the value reflected as the gross up amount. But ignore that point. What should be the reporting of the financial asset exactly on the balance sheet? Yes, we have to mention this point. Financial asset with the ledgers reflect 24.45 and loss allowance with the ledger reflect 3.34. That's the point. Sir, what should be the answer with respect to the exam context? Here, examiner mentioned explain how Jacinta should account for. Explain, account for with all these things, including journal entries. Sir, how we will write the answer? That's the point. So let's start the discussion about the answer with respect to exam context. So I must say here you need to point, here need to cover that. If you are going, and we have covered a concept about the purchase credit impaired financial asset and also consider the Jacinta company. I'm providing you the drafting support here. Number one, 8 marks question, allocate your time. Number one rule for 2080 and allocate your time for 8 marks. You have 14 minutes. Number one, 20 minutes you have to invest for planning. That's 3 minutes. Brainstorm, that's include reading, understanding, and identify the key points. Sir, what should be the key points here? If this is 8 marks question, I suggest that first of all, relax and very basic point. Financial asset, initial recognition. First, a very basic point. Initial recognition. First, you have to incorporate the initial recognition. Then, accounting. For initial recognition, very simple. Just mention the concept and able to get 3 marks. Accounting with the original commitment, 2 marks. And then impairment gain. That's 4 marks. This is what about the brainstorming. Don't make mistake that, no sir, I will not make any brainstorming or identify the key points, or without planning I'm going to attempt the question. Never, never, never. Always plan your question first. Identify these key points and commit it with the point. Make a heading, for example, make a heading about initial recognition. Variables, basic. Number one, IFRS 9 requires recognition of financial asset on a forward-looking basis, referred as ECL. This means impairment loss is recognized before occurrence of the credit event. Basic ECL rule. IFRS 9 requires that financial assets should be reported as its risk of expected loss, regardless of risk already materialized or will materialize in future. Then you need to mention a little bit. Purchase credit impaired financial asset, if recorded at initial recognition at transaction price without presentation of allowance of expected contractual shortfalls. This is because expected shortfall already part of implicit in the purchase price. So first IFRS 9 basic rule, then purchase credit impairment loss. Very basic. Then accounting, very basic accounting, that we have already done. Initial recognition and accounting without any impairment again. Very basic, whatever we have done. Sir, where we should do the double entry and these accounting? I suggest that for these type of working, the double entry and the accounting, you have to work out with the spreadsheet. Here examiner already attach the spreadsheet. So you have to mention these things with your spreadsheet. All these things in this manner. Number 3, movement in expected credit loss, 4 marks. The amount recognized as loss allowance in financial asset is not the total amount of lifetime, but instead the change means something positive, something negative, something more impairment, not the case, something reversal of impairment. Here is the case. So here mention that it's at initial recognition, it's not the confirm accounting, it's not the fixed accounting. It may change according to the circumstances. Now, any favorable change in the lifetime is recognized as impairment gain. The revised expected cash flow should be discounted using the EIR and compared to the expected cash flows. Here I mentioned that refer to spreadsheet. Whatever we have done, the working of a spreadsheet with the reversal of impairment. You can also draft your answer by explaining this working rather than mentioning this working. Rather than independently mention the calculation, you just explain your working like this. The revised cash flows shows increase of 1.2 million per annum, X7 onwards, and discount amount of this change 3.34. Discount amount you just mention in this way. But what I personally suggest that with these type of complex calculations, don't just mention with your draft, rather than first calculate and then refer the calculation here. You can also mention that refer the spreadsheet. So this is impairment gain 3.34 recognized in P&L. Mention the double entry at 31st December X6, the following amount recognized in the financial statement: financial asset carrying amount 24.245 and loss allowance debit balance 3.34. There is some alternative solution for the gain, but what I personally think that if you have already understand that point, no need to cover the alternative solution. Let me explain the alternative. Alternative here means at end of 31st December x6, you need to calculate the value with the original amount, with this original amount. What if the company will collect the original amount 8.8 and discount with 3.9, so value equal to 24.47. If they will receive the higher amount, that's 10 million, the value is 27.8. so that means the value become increase 27.8 minus 24.7, so the change become 3.4 million. So you can also work with this alternative solution. Instead, if you are comfortable with this, no need to refer for the alternative. So that is all about this part of the question. But one last point and very important point, that's examiner report diagnosis. That's the examiner report diagnosis, September, December 23. Very important for your upcoming exam. Question number 3, Jacinta, part A. So here, the weak answer, need to, the highlighted point. IFRS 9 is a core SBR topic area. Despite this, candidates' performance on this requirement was very weak. This requirement was often not attempted or very little was written. Students, here I must say the very important point, like these type of standard IFRS 9, IFRS 15, whenever you face the examination and you feel that you are facing difficulty with the question, number one, relax. Remember your God Allah. Recite something just for 15 seconds. And believe me, with this type of difficult question, assume that this is 8 marks question. In fact, this is 8 marks question. You will be able to easily get 3 to 4 marks. Because examiner allocate the marks with one requirement, examiner allocate the marks. For example, here, the marks are allocated between these 3 points. Initial recognition. So easily you will be able to start your answer with the expected credit loss and get 1 or 1.5 mark. Very simple. Yes, I know calculations are difficult, but at least you must be part of game, which means that if you just leave the complete question, actually you are out of the game. If you are in the game, you will be able to get some marks. So if examiner complains that this requirement was often not attempted and very little was written, try to overcome this point. First, start writing with your comfort, with the easy marks, and then enter with the question. Irrespectively, the things become right or wrong. So 2 steps. Number 1, relax and start your answer with the easiest way. Once you start with the easiest way, your confidence will build up. And then if you move on accordingly, whatever you feel that right or wrong, whatever, you will have to attempt the complete question. So you need to overcome this problem, not attempted. So in your dictionary, what I suggest, not attempted, it's no words. And another one, very little attempt. So always attempt the questions. Number 2, be the part of game. Always try to attempt the 100%. Irrespectively, the things become right or wrong. So you will be able to pass your exam. Number 2, those who did attempt part A often gave answers which were technically incorrect and far too short to achieve good marks. So, okay, if that means that you must have a good coverage of entire syllabus. Those who did attempt question often omitted journal entries. Oh, that means you haven't read the requirement carefully. Read the requirement carefully. It can also it can only be assumed that candidates did not know what journals to give. Okay, so overcome these things. Good answers. Good answers are well structured, which means good candidates were able to both explain the rules and apply the knowledge. Ideally, your answer should be initial recognition at transaction price, interest income, impairment gain. Whatever the three brainstorming points I have covered, that's a point. Initial recognition, accounting with the amortization schedule, and impairment gain. This is the point. Examiner comment. It's not my. Your efforts always count, even it's not correct. Credit was given to candidates who made a good attempt at this calculation and recognized that impairment gain had arisen, even if the calculations contain errors. Actual point is that your roadmap, your path to attempt the question, irrespectively something right or wrong. Students, that is about the part A. Now we are going to start with the part B. I strongly suggest at this point you have to pause, relax, and then read the part B first and then watch the another part of the video. Thank you very much. Okay, students, Jacinta Company, December 23. Part B, IFRS 5, IFRS 15. That's about 10 marks. I hope that you people have read the question. If not, pause the video. First of all, have to read the question. Student, one very important concept the examiner examined a very important concept here, and that is about sale and repurchase agreement with put option. Sale and repurchase agreement with put option. That customer has a right to sell. So first of all, we have to make a quick overview about the concept, then we will penetrate with the question. Number one, seller to recognize the revenue has already made sale to the buyer, but with this transaction, buyer has the put option. Buyer has the put option. Buyer has the put option means at one side, seller has handed over the goods to the buyer. Further, also made a contract of put option, and put option held by buyer. So someone holds a put option, that means right to sell. So buyer has a right to sell means it's possible that seller has obligation to repurchase, because here the seller as a writer of the put option, or we can say here obligation to repurchase. So in this case, accounting standard says that whenever seller has made the transaction, at the date of transaction, the seller need to determine either the obligation to repurchase is expected to occur or not. At the time of transaction, seller has need to consider or assess the situation. Either this obligation will materialize or not. So the situation will be made in this manner. Now, seller obligation, that's obligation to repurchase, need to assess either the obligation exists or not. If the answer becomes no at the transaction, that the situation is that this put option will not expected to materialize. So that means the seller will recognize the sales. So once again, seller at the time of transaction need to assess the obligation will materialize, yes or no. Yes or no. If no, so that means the seller has sold the goods. Although also provided, also have written the put option to the writer, to the buyer, and the buyer is a holder of the put option. But at the transaction date, this is not expected to materialize. So here, we will consider that sale has made, because whatever the option we have written, the seller has written, it's not possible to materialize. But on the other hand, at the transaction date, if there are expectation that put option will materialize, so we need to assess either EP means exercise price is equal to or greater than OSP, original selling price. Exercise price equal to or greater than original selling price. If this happens, seller will not recognize the sales, but the transaction will record as a loan. If the exercise price of the put option is less than original selling price, original sales price, so in this case, sale will not recognize, but the transaction will record as a lease contract. That seller only provide or handed over the inventory to the buyer as a lease contract. So whenever you will face a case of, or you will handle the case of sale and repurchase agreement with put option to the buyer, which means customer has a right to sell. Customer has a right to sell. Here the buyer here the seller need to assess either the obligation is expected to materialize or not. At the transaction date, we need to assess. If at the transaction date the material is the buyback or repurchase is not expected to materialize, so we have to recognize the sales with the rights of return. If yes, then it's not the sale, and we need to cover one important more point: either expected price, exercise price equal to or greater than OSP, original selling price. If yes, that's a loan, not the sale. If expected exercise price less than original selling price, also not the sale but the lease. So this issue we will cover with part B of Jacinta. B1 in fact, B1. Now come on. This is the question requirement. Explain how revenue from the internet contract, internet service contract, because it's a telecom company, and sale of equipment to share company should be accounted for in accordance with IFRS 15, revenue from contracts with the customer. So this is 10 marks question, 10 marks. Now come on. Actually, B requirement having two different points. Number one, revenue from share company. Revenue from share company. On 1st January 6, Jacinta entered into a contract to provide share company with an internet service for 2 years. Okay, Jacinta is a telco company. They have entered with a contract to provide share company, a buyer, for the internet service for 2 years. The contract price was agreed $2 million, which was received in full on 1st January 6. At the same date, Jacinta company sold equipment to share company at its fair value of $500,000. At the end of the internet service contract, 31st December 7, share company has a right to return the equipment to Jacinta and receive $20,000. Jacinta anticipates that equipment fair value will be $75,000 2 years time. Market value of the second-hand equipment is very strong. Share company will be able to sell the equipment easily at the end of the 2-year agreement. Jacinta does not want to deal second-hand equipment and therefore always price equipment returns at an amount substantially below fair value. Share has never returned equipment to Jacinta in the past. So actually with another part of inventory to overseas subsidiaries we will cover later. Revenue from share company having two parts with one case. Once again we need to read. 1st January 6, reporting date is 31st December 6, with this case. 31st December X6, yes. Okay, 1st January X6 means air start. Jacinta entered into contract to provide share company with internet service, 2 years. The contract price 2 million, which was received full and 1st January X6. So this is the aspect of internet service. And here examiner asks you how revenue from internet should be accounted for. So you need to recall your basic knowledge of IFRS 15. Here examiner expect you to apply the knowledge about step 5, revenue recognition. And step 5 for revenue recognition, here the services point, and we need to determine how to recognize revenue at one point of time or over the period. One point of time or over the period. So here you need to cover the point. Here you need to cover the point. Either the Jacinta for internet service should recognize one point of time or over the period. It's very simple. According to the IFRS 15, if the company simultaneously deliver the goods and the customer simultaneously, if the company delivered the goods, Jacinta delivered the goods, and the customer simultaneously receive and consume the services. Simultaneously receive and consume the services. That means the company, Jacinta here, seller recognize the revenue over the time, not one point of time. So if the Jacinta received $2 million start of the year, so 2 million for 2 years contract, so 2 million must be splitted or categorized into 2 years. If they received complete amount, so 1st January X6 bank debit and contract liability credit at the year end, contract by 2 million. At year end, contract liability debit and revenue should be recognized credit at $1 million. So it's very simple. Revenue should be recognized 1 million based on the revenue recognition over the period. So that's you need to draft. Very simple. But another point, at the same date, Jacinta company sold equipment to share company. Equipment, and that's another point. At fair value 500,000. This is the selling price. At the end of the internet service contract, 31st December X7, share company has a right to return, share company, who is share? Share as a buyer, has a right to return equipment to Jacinta. So if buyer has a right to return equipment to seller, so that means here Jacinta seller has an obligation to buy back. So it's something with respect to Jacinta sell equipment to the share, to the buyer, and also provide the put option. So share, the buyer is a put option holder as well. So share has a right to return the equipment to Jacinta and receive 20,000. This is exercise price, 20,000. So be committed that we are Jacinta company and we are the seller and the writer of the put option. The exercise price 20,000. Now here we need to consider either at the time of transaction, Jacinta must have to assess either the put option will be materialized or not, the application exists or not. If no, that means have to recognize sales. Yes, then we will cover the point accordingly. Jacinta anticipates at the time of transaction, 1st January X6, the equipment fair value will be 75,000. Will be 75,000. If after 2 years, the second-hand value or the fair value expected 75,000, and here buyback we have locked the price, the excess price 20,000. So you need to think yourself. At first point, will the buyer will exercise this option with the Jacinta? In fact, with the market, they are expecting to receive the higher amount of 75,000 as compared to the 20,000. No. So with first statement, although there is a put option, but it's not expecting to materialize. Further, the market for second-hand equipment continue. is very strong, and seller would be able to sell the equipment easily at the end of 2-year agreement. Further, hammering effect, second point, seller with second-hand value of 75,000 easily they will be able to easily sell the equipment to the market. Jacinta does not want to deal second-hand equipment, although they don't want to deal second-hand equipment, and therefore always price equipment return at the amount substantially below the fair value. So they have a commitment to sell even less than 75,000. Seller has never returned equipment to Jacinta further. Never returned. So if we collect all these points, so we can say that here this point is easily applicable. Sale and repurchase with the put option, but not expecting that put option will materialize. That's the point. So here seller will recognize the sale, Jacinta here, with any expectation of the right of return. With any expectation of the right of return. So whatever the right of return, we need to consider, apply the rule of the right of return as well. So this is the practice question of Jacinta. There are two aspects, revenue recognition and revenue recognition 1 point or over the period, or specific case about a sale and repurchase agreement without put option. Rule is 20/80, 10 marks question. Time allocation, first of all, allocate the time. Total 14 minutes you have. Plan your answer at least 3 to 4 minutes. Read it carefully. Identify the case. Brainstorm. Brainstorm. Reading, understanding, identify the key points. So if you are going to write this answer, very simple. Out of 10 marks, examiner allocated for internet, services, that's 4 marks. So very simple. You have to put a knowledge of, you need to think about, I will draft about the knowledge of 1 point, step 5 or over the period. Number 2, knowledge and then application. 2 marks for knowledge, 2 marks for application. For equipment, this is about 6 marks. Sales and repurchase with put option. You have to mention the complete knowledge. By sir, do we need to mention the complete knowledge? No. If you have read the question carefully and you have identified that here is about seller don't have expected obligation, you just focus your knowledge about the very particular area. Here here at transaction date, there is an expectation that sales obligation will not materialize, and put the knowledge with seller obligation, repurchase, no. That's all. Sale and repurchase with put option, and in fact you have identified that no obligation. And then you have to mention that how to recognize the revenue recognition. That's all. That's the brainstorming you have to make before answering the question. Now come on, very quickly. This is internet service. In accordance with IFRS 15, each performance obligation requires determination of whether satisfied by transferring of control goods over the time or point in time. So transferring the control of goods and services over the time or one point of time. With regards to internet service contract, customer simultaneously receive and consumes the economic benefit of the provided service as the Jacinta company performs. Revenue should recognize over the time. Revenue of 1 million recognized each year. 31st December X6 contract liability of 1 million will be presented at a current liability as a current liability on the statement of financial position. Equipment, yes, very simple. This is the case for sale and repurchase agreement with the put option. Customer has right to sell. Here's the put option means an option to force the seller to buy the asset at a set price. IFRS 15 says that accounting of a sale and repurchase where customer hold a put option depends whether put option creates an obligation for seller to repurchase. This needs to determine at the time of transaction. If no obligation exists, so tilt your answer, that's no obligation, because you have read the question and you have identified no obligation. Transactions recorded by seller as sale with right to return. That's all. Here the case about Jacinta. Don't have application, but you need to justify your answer. Don't have obligation. Why? Share company has a right to repurchase, exercise price 20,000, lower than the original price of 50,000. Number one. Number two, they are anticipate that fair value will be 75,000 over the time. Additionally, market for second-hand equipment very strong, and share company would be able to sell equipment easily at the end of the 2 years agreement. That's a point. So these 3 points very easily you need to mention here. Okay, further, conclusively, shareholder is able to obtain substantially all the economic benefit from equipment. So control of equipment is transferred from Jacinta. Means if there is no obligation, that means control is transferred. Now, 1st January X6, Jacinta should recognize transaction, add sales revenue with right of revenue. Sorry, with right of return. So right of return, refer your original accounting standard with the relevant steps. Revenue with major gross transaction price 500,000 less any expected value of returns, which in this case will be nil. There's no information or there's no chances of return. No, that's a value of nil. This means no refund liability or return asset will be recognized. That's all. Jacinta will update its measurement as a refund liability and return asset. Each reporting date, the change is the changes in expectation about the amount of refunds. You know very well, the return of assets or the return of the particular inventory must have to reassess over the time period. If the conditions become changed, you have to reconsider the refund liability or return assets matter. Okay, so that is the point about the part B1. Students, part B1. Yes. Here the examiner report. Very basic examiner report. The points for examiner report. IFRS 15 is an important part of syllabus, SBR syllabus. They were very comfortable with the internet service contract. You people have done very good. Correctly saying that the students were done very brilliantly. Correctly saying that revenue in this part of the contract should be recognized over time. Fewer candidates, okay, this is the alarming point. Fewer candidates were able to state that there was also a liability as a full amount of revenue has been paid in advance. So this is a good thing that you need to notice here. If you really wanted to get the highest marks. First day, that's liability. First year end, liability become reverse and revenue should be recognized. A limited part of the liability will be recognized in the balance sheet at the first year end. Second point, the treatment of equipment was not as well answered. However, stronger candidates of IFRS 15 knowledge and then when to apply to this, to the numerical scenario provided. So students, the important point is that keep revising your content and apply your knowledge apply knowledge as maximum as possible. Don't stop, keep moving. So this is part B1. Part B1. Student, part B2. Part B2. It's about something related to group accounts. Something about the group accounts. And it's very simple. Sale of inventory to overseas subsidiaries, and how to account for with individual books and as well as for the consolidated books. It's very simple. Explain with calculations how sale of inventories would be accounted for individual financial statement of both Jacinta and overseas subsidiaries and in consolidated statement of financial position. 2 to 3 points need to consider. First of all, a part of overseas subsidiaries. If parent or subsidiaries makes some transaction or makes the transaction of sale of inventory, so with individual books, this transaction will reflect definitely. And in consolidation, this is intra-group transaction, sale and purchase should be reversed, and unrealized profit should also be reversed. It's very simple. Number two, with respect to the overseas subsidiaries, yes, there's a point of exchange gain and losses as well. So you need to consider about the exchange gain and loss. Students, I am not discussing this point because it's very simple. In fact, you will be able to get the suggested answer with that particular point. So you just attempt by yourself and compare with your suggested answer. I will provide you the description as well as the calculation part as well. So this is all about the Jacinta question. And in fact, you can also read the examiner report extract as well. So this is what about the complete discussion of the Jacinta point. Now students, this is all about Jacinta. So with respect to the Jacinta, thank you very much. But now, one more thing with our agenda point, that's something about the conceptual framework point. Conceptual framework. So group accounts point you will work out. Yes, conceptual framework. I will discuss a question about the conceptual framework as well. How to cover the points of conceptual framework. Although with respect to conceptual framework, first of all, you have to recall your knowledge quickly, bare minimum, read the study hub material or your notes or the study decks. Number two, practice question, whatever I've referred to you, 3 practice questions. Here I'm discussing a very basic question. Now let's start. Yes, this is a question. Hive company owns a machine. Read it carefully. Hive company owns a machine that is central to its production process. At the reporting date, the machine carrying amount exceeds its tax base. So question start with some deferred tax matters. The difference is due to revaluation of asset to fair value in the financial statement. Due to its importance, it is extremely unlikely that machine will be sold. At the year end, Hive company received 10 million from investor. In return, Hive company must issue ordinary shares of 12 months time. So another area of the accounting, investment, that is financial instrument points. Okay, the number of shares to be issued will determine based on the quoted price of Hive shares at the issue date. Here the requirement. So examiner also examine the conceptual framework with this manner. For each of the above transaction, number one, briefly explain how it should be accounted for accordance with IFRS. So that means very clear heading about a deferred tax and financial instrument. But SBR questions, in SBR questions, conceptual framework always integrate with the scenarios. Discuss why accounting treatment could be argued contradict with the definition given by conceptual framework. So that is the point. So that means here you need to incorporate your answer of conceptual framework with two accounting issues. For example, if you are covering deferred tax, so deferred tax very basic amount, very basic about the accounting issue here. For example, the carrying amount as asset exceed tax base as per IAS 12, deferred tax liability must be recognized. Okay, very simple. The deferred tax liability measured by multiplying the temporary difference by the tax rate. Very simple. And tax charge is recognized OCI in case the revaluation. Deferred tax is application of accrual concepts and it recognizes the tax effect of transaction in the period the transaction occurs. Also, this is what about the knowledge area of the accounting issue. Very basic. Hive has no plans to sell its assets. There is no present obligation to pay tax to arise in disposal. Now, the points of discussion here start with the conceptual framework. For if we record the deferred tax liability for the fair value adjustment, so in fact, fair value adjustment make here, and we are recognizing the deferred tax liability, but there is a question. Deferred tax liability we are reporting in a scenario that whenever asset will sell, we will provide that tax. That means deferred tax liability. But the point is that the company has no commitment at the fair value date that company will sell the asset. So if the company don't have any commitment to sell the asset, but IAS 12 says that even the company has no intention to sell the asset, but you have to record the deferred tax liability. So why it is? Because the requirement of IAS 12. Requirement of IAS 12. But first of all, you have to mention the conceptual framework. The conceptual framework defines liability as a present obligation of an entity to transfer economic result as a result of the past event. You know that there oftenly there are some contradictions between accounting standard, application of accounting standard, rules of accounting standard, and conceptual framework. One of the example is there. If we are recognizing the deferred tax liability here, there is a contradiction because conceptual framework defines liability as a present obligation, but we are recognizing the deferred tax liability as a present obligation. If we are recognizing the deferred tax liability, here deferred tax liability is not actually meets the definition of deferred tax liability because there is no current obligation. The company don't have intention to sell the asset. So what you should do first, whenever you are integrating the conceptual framework, I suggest that first you refer the knowledge of conceptual framework, then start your points. Very basic point. Deferred tax liability does not appear to meet the definition of deferred tax liability. Does not meet the definition of liability according to conceptual framework. Very basic. However, board rejects this position, and board argues that increasing carrying amount of asset must result future economic benefit of reporting entity. Otherwise, carrying amount will be overstated, and these inflows of economic benefit subject to tax. So here, board rejects the position about that. Board rejects what position? Board rejects the position that if we are not recognizing the liability, so actually the assets, it's now net assets become overstated here. For example, the fair value gain may be due to higher selling price of its output, which will therefore increase taxable profit. So board actually rejects the position with respect to the conflicts of the conceptual framework, and someone says that not to recognize the deferred tax liability because there is no liability. Board reject this position, and board says that whatever the asset you are recognizing here or make a fair value adjustment, you will get some future benefit by using the asset. So if you are using the asset and get the benefit, then you need to recognize the deferred tax liability as well. So the board argued that tax is payable on the revaluation, irrespectively how the asset is used. I know that this is not the complete justification, but you have to mention your position accordingly. That is the point. Same for financial instrument, for example. First you mention, or whenever conceptual framework integrate your accounting issue, first of all, you easily cover your accounting issue. For example, IAS 32 is financial instrument present that financial liability is a contract to deliver cash and another financial asset or variable instrument of own equity shares. Contract requires Hive to deliver as many as equity instrument. If the equity instrument commitment is variable, if equity instrument commitment is variable, that should be a financial liability. You know very well. An equity instrument is not a resource of entity, so contract does not represent obligation to economic resource. So according to the conceptual framework, this is not a liability because there is no obligation to pay cash, no resources. So this means that financial liability does not meet the definition of conceptual framework. Yes, exactly. But once again, although, do remember, although some of the accounting standard issues like IAS 12 or financial instrument not meeting the definition of conceptual framework, but accounting standard requirement overrules, always overrules, and record accordingly. So this is actually the debate which have different angles and never be complete. But do remember, I wanted to complete my discussion here, always overrule the accounting issues. Finally, students, focus and compose your mind. If conceptual framework examine with integrated matter, relax. First you cover the accounting issue, and whatever the knowledge about you have the conceptual framework, do your best to apply the things. Examiner will never fail you if you are not properly integrate conceptual framework, if you not properly integrate your conceptual framework answer. But in examiner will fail you if you not try, if you're not able to put efforts to integrate the conceptual framework with the case. So in simple words, it's not about right or wrong. It's about your efforts, and already mentioned with the with the examiner report. So just get rid of fear, get the knowledge. 3 questions, whatever I mentioned with my presentation, you have to attempt with your own, and that is all about conceptual framework. Go with the exam with that particular motivation. So this is all about module 4. Thank you very much. I will provide you the guidance with the module 5, how to tackle the current issues, performance measurement with multi accounting standard issues. So thank you very much. Take care a lot. Assalamu alaikum.